Hi, I'd like to thank KUSAPS for inviting me down here. And because I have time pressure, I'll just leave it at that. This is obviously a great place to be. And what I'm going to talk about is the relationship between China and the US over the past 20 years. A lot on the past, not so much on the future, because it's much easier to predict things about the past than it is to predict things about the future. But we can learn some things from looking at the past. And what I want to tell you is that from about 91 to 05, the US and China had a codependent economic relationship that was built around cheap oil, cheap Chinese wages, and I'm tempted to say cheap credit, because that is an important part of it, but what it really is a lot of credit-worthy consumers in the US. So those are the three C's: cheap oil, cheap China, credit-worthy consumers. And this relationship worked for roughly 15 years. And then, as these relationships often do when they're codependent, it fell apart because of endogenous dynamics. And the endogenous dynamic was that cheap oil, cheap Chinese wages, and cheap credit were a substitute for rising relative income, and actually in the US, even rising absolute income that might otherwise sustain growth. So what I'm going to do in the next few minutes is walk you through a very stylized picture of the American economy and a very stylized picture of the Chinese economy. And then I'll talk about some details in the dynamic around those three C's, and then I'll talk about the end of the three C's, and then I'll make a very quick minute of predictions about the future and tell you that the other presenters are going to say much, much more about that because they know much, much more about it than I do. So, 1990s US, how did things work? The basic model is in some ways very simple, and as I say, this is very stylized. There's a lot of hand-waving in here. If you want me to talk at length about the actual details, I can do that, but it's not so exciting for you. I'm going to give you the big picture instead because this is, a movie with lots of action. That's the Two Towers business. And the basic dynamic in the 1990s emerges out of this vast global disinflation that occurs. And for reasons that I won't go into, but which are really important, disinflation flows through the American housing finance system to generate a lot of extra consumption. And the central point here, the one sentence you really need to know, is that Americans have a one-way bet on interest rates with their mortgages. We have the great privilege of getting a 30-year mortgage at a fixed interest rate, which is already a great privilege, and even better, you can go in and renegotiate the loan and lower the interest rate when the open market interest rate falls. So disinflation percolated through the American housing finance system to generate a lot of extra consumption, because when people renegotiate their mortgages, they have extra cash, and being Americans, when they have that extra cash, they spend it. And that spending drove faster American economic growth. And here's where we start to see the connection to China, which is the emergence of large US trade deficits over the 90s and then especially the 2000s. In the 90s, though, it was mostly Europe, OPEC, and Japan that were the sources of the deficit. China's really more about the 2000s and the exaggeration of this routine. But what's central about China here is that China recycled its trade deficit with the US by buying US Treasury bonds. And that mattered for this dynamic because US Treasury bonds are the reference rate for American mortgages. So the more China recycled American trade deficits back into purchases of Treasury bonds, the lower interest rates went on American mortgages, and the loop is closed. Even more consumption comes out. And because cheap China was also providing cheap goods, that led to a lowering of inflation rates and disinflation in the US, also reinforcing the dynamic. And on top of that, there was a political piece, which was that the Fed, in response to rising tax rates, opted to keep interest rates low because they weren't afraid of inflation reemerging or having a fiscal deficit. So this is the basic American model, and the contact with China is these beige boxes here. Okay, what about China? It's, of course, a different story, but it's a story where the important points of contact are the recycling of trade deficits. So the Chinese story starts with a repressed financial system, low interest rates, a very weak welfare state, which induces a lot of saving. Because interest rates are low, savings are higher than they would otherwise be. And this saving, and here's some sleight of hand, so be careful, but this saving is mobilized through state banks and party elites, and this is the sleight of hand right now. I'm going to say this leads to export investment. In fact, it doesn't, but at a macroeconomic level, it does, and that's what really matters. So China gets this huge mobilization of capital, partly domestic, partly foreign, that generates a huge, huge increase in export flows, and this produces trade surpluses. And to sterilize those trade surpluses and prevent the yuan from rising and reducing the trade surplus and reducing the growth impulse that comes from the exports, the central bank sterilized the inflow of dollars. And when it did so, it drove interest rates down even more, which then induced more saving, more exports, et cetera. And here, too, there was a secondary dynamic in which people's necessity, the necessity of saving, led to a decrease in the share of consumption in the economy, reinforcing the export-led orientation. So here again, we have the connection right here with the US economy, or between the US economy and the Chinese economy, is that trade deficits are the locus for the reduction of interest rates in the US that leads to extra US consumption that drives the US economy. And in the 90s and in the zeros, the US and China account for a huge share of global growth. And we know that this is a political outcome. It's not a natural economic outcome. And it's a political outcome for two reasons. On the American side, there could easily have been a huge and early reaction against the outflow of jobs to China as cheap Chinese labor for consumer non-durable production rises rapidly. But at a geopolitical level, if I can connect to Mr. Beasley, who's I understand is in the box over here, at a geopolitical level, in the 1990s, the US was concerned with containing Japan. And the way you contain enemies is to find a balancing force. And so the US is building China up to contain Japan. And the US is also concerned with the Europeans in the 1990s. China's a distant enemy, if you will. The Europeans and the Japanese were the proximate enemy once the Russians disappear as a major military force. And so the US is going to tolerate Chinese access to the US market. And on the Chinese side, of course, there's a political decision to accumulate reserves. And that's done by keeping the yuan at this remarkably constant level, despite rising Chinese productivity, and which we would expect would change the exchange rate between the dollar and the yuan. And you can see this if you compare Chinese and Japanese exchange rates. I'm going to say that rather than the currency names because they're so close, but Chinese and Japanese exchange rates with the US dollar. This is a graph of the exchange rate with the dollar. Down means these currencies are getting weaker, so this is an inverted scale. Red is the yuan, the Chinese yuan. Green is the yen. And you can see the yen bouncing around, especially after China's massive devaluation in '94. You see the yen bouncing around. And at that time, of course, the US press was full of allegations of Japanese currency manipulation. But in the meantime, you have this extraordinary, truly extraordinary, right, straight line. That straight line, by the way, is built on an Excel file with daily exchange rate data. And there's no variance. Until we get to the crisis, 2006, and then yuan starts to go up again. Okay, so there's a political nexus there. And that political nexus produced this enormous US trade deficit with a growing share for China. So here you have the US trade deficit in billions of dollars. And you can see that China is not solely responsible for it. The important thing actually is that excess American consumption was rising on all fronts. And that's because this same dynamic I'm talking about between the US and China was also present with the US and Europe. And the difference is that instead of buying cheap clothing from China, with Europe we were buying expensive Mercedes and BMWs. So yuppies bought from Europe, and puppies, poor urban proletarians, bought from China. But in the American imagination, the problem was China and secondarily OPEC. Europeans are okay. They're not enemies. And the underlying reality behind that was that in the 1990s, China was a small part of the deficit, but by the 2000s, it's a large part and a growing part. And before I get to that, I just want to call out one thing that's a little bit relevant for later, which is, oops, sorry, this is the slide I'm talking about. So you can see the Chinese share in red growing, but the deficit as a whole is growing much, much more. And the one thing I want to call out is right here, 2009, sharp reduction in US trade deficit, goods and services only, and then it starts to pick up. But China's share grows even though the deficit is shrinking. And so, as I say, in the imagination of Americans, what they see is not an absolute level so much as a relative level, which is that China plus OPEC, or China plus OPEC and Japan, China, Japan, OPEC, becomes a larger and larger part of the trade deficit. China's the problem. So politically, it's harder to sustain this relationship. But the politics actually are less important than the fundamentals, and the fundamentals here are the end of the 3 Cs, the end of cheap oil, cheap Chinese wages, and credit-worthy consumers. So 2005, 2006, 2007, you have a set of shifts. Oil prices go up. The subprime market explodes, which is your signal that credit-worthy consumers are disappearing. And Chinese wages start to gently move up, and the yuan starts to move up, which magnifies that. And these things will all expand as we go from 2005 to 2000. So just some pretty pictures to confirm that I'm not lying. Here's oil prices. This is the end of cheap oil. $22, $23 a barrel average price from roughly 91 to 05. I could make this graph even starker if I pushed it into 06, but we don't have to do that because from 05 on, average price is over $80 a barrel. Why does that matter? It matters for 2 reasons. Expensive oil means expensive transportation fuels. And that means American consumers are stretched. They spend more for gasoline to go to work. And if they're spending more for gasoline, they can't make payments on their mortgage or they can't buy cheap Chinese goods. So that's one side. And expensive oil, oil as a transportation fuel, means cost of transporting goods from China to the US also rises. So this is really important for changing the equation that links China to the US. And the reason I say transportation fuel is that what we've seen in the last few years is a growing divergence between fuels for manufacturing in the US and fuels for transportation. Liquid fuels for transportation, petroleum, gasoline, that's gone up, but electricity generation fuels, which are now heavily based on shale gas, natural gas, those costs have been stable or falling. Natural gas prices in the US have been falling, and roughly 10% of American energy consumption is now coming from shale gas. So this changes the equation about where you manufacture. And why might you think about that? Well, again, cheap Chinese wages. When we were moving billion people from this to this, it seemed like there was an unlimited supply of labor, and even more important, an unlimited supply of docile labor, and that's basically gone. And it's gone not so much because there is an end to all of this, it's gone because those people in the factories are no longer docile. They're starting to strike. And so you can't go to China anymore and expect that you'll have production stability with cheap wages. Okay. Cheap credit for American consumers, also gone. This is a chart of American households' debt. The orange bit is mortgages. That's the single most important part. That's why I stressed mortgages in the model. The orange bit is mortgages. That's why I stressed mortgages in the model. You have an almost tripling of debt from 99 to 08. You're shaking your heads. I'd like to see a similar graph for Australia. I suspect it's just as shocking. 07, 08, it starts to decline as people begin defaulting on their mortgages and their credit cards. And the drop is not so much because people are saving. The drop is because they're defaulting. So what you see here is consumers in good standing. This is percent. The red bit is people who are seriously delinquent. They're not paying anything. And it goes from the normal 2 or 3% to almost 5%. And the number of consumers in some kind of credit default situation or credit weakness situation triples. This looks like a small change, but I mean, in the context of an economy in which a lot of people have a lot of debt, it's huge implications for the banks. And the drop in debt that you saw on the prior slide is a function of banks not lending to consumers because there's nobody to lend to. So cheap credit disappears. And what that means, now we're into the future bit. Oh, only one more minute. Good, that's good because I can give it to everybody else. When we look at the equation that motivated American manufacturers and motivated Chinese overseas capital to go to China to produce for the American market, the equation was cheap wages in China, cheap transportation fuels, and that equation has shifted. So 2006, wage difference between China and the US in terms of costs, still pretty large. Transportation costs, pretty minimal. By 2010, the extra transportation cost of shipping from China is higher than the wage gain. So now, on a net basis, it's cheaper to manufacture in the US, and what we're seeing is a reshoring of some production. It won't all come back, but what it means is that link, that trade deficit-driven link between China and the US is gone. And the limit to that going forward is whether American consumers can actually get money and whether Chinese consumers can rebalance towards consumption. I don't have a genie for China, but what you see in the US, of course, is widening income inequality. And so if we think about the big model here as a model built on cheap credit, cheap oil, and cheap Chinese wages as a way to overcome stagnant incomes, to be a substitute for stagnant incomes, we can look at America and say that problem has not been solved. Income inequality is still getting worse. And so the problem moving forward is thinking of a way to increase income in America and increase income at the bottom in China, increase income at the bottom in America and in China to provide some kind of new growth engine. And so as I understand the protocol, we'll take questions at the end. So I thank you for listening patiently, and I hope that wasn't too compressed.